Welcome to another deep dive from Empowering Your Finance, focusing today on Social Security. We're tackling something causing a lot of worry: Social Security benefit cuts, specifically linked to defaulted student loans. We've got some listener sources here that look like a really vital guide through this whole complex situation. So, our mission today is to unpack these sources, figure out exactly what's happening, and maybe more importantly, what you need to know and what you can actually do about it.
That's right. And it's a big deal now because after that pandemic pause, federal student loan collections are fully back online. This includes the government intercepting other federal payments. And yeah, that definitely includes Social Security benefits if there's a defaulted student loan. It's hitting thousands of people now, especially older Americans and, folks with disabilities who often really depend on these benefits.
Okay, so let's jump straight into this alarming reality then. What the material seems to show is the main mechanism is the Treasury Offset Program, TOP.
Exactly, TOP. Think of it as the government's tool for collecting debts owed to federal agencies. If they owe you money, like Social Security, but you owe them money, like for a defaulted loan, they can use TOP to, well, take it before it gets to you. And yes, it's actively being used again for defaulted federal student loans, intercepting those benefit payments.
Right, and the sources get specific about how much, don't they? How do the cuts actually work?
They do. The general rule mentioned is that they can take up to 15% of your monthly Social Security benefit. 15%.
15%, wow. But there's a protection.
Yes, crucially there is. The sources state your benefit cannot be reduced below $750 per month after they take the offset. So that's $750 like a floor, a minimum safety net. But anything above that $750, well, that's potentially vulnerable if you're in default.
And this $750 floor, that connects to a policy change mentioned in the material, doesn't it?
It does. This is quite significant. The sources note the Trump administration reinstated these collections and set that specific $750 minimum. Apparently, this reversed an earlier Biden administration policy direction that aimed for a higher floor, something like $1,883 per month for some defaulted borrowers.
That's a massive difference, going from potentially $1,883 protected down to $750. That's huge for someone on a fixed income.
It absolutely is. It really highlights the policy tension here. And with that $750 floor, you have to ask, who's really feeling the pinch the most? The sources point pretty clearly. Older Americans, maybe those who took out parent POUS loans or cosign, and definitely individuals with disabilities relying on SSDI, Social Security Disability Insurance.
Right, those groups are often heavily reliant. But the material also draws a line regarding SSI, Supplemental Security Income.
Yes, that's a really important distinction they make. SSI benefits are generally not subject to this kind of Treasury offset for student loans. It's because SSI is fundamentally different. It's needs-based, funded differently, and just operates under separate rules when it comes to these kinds of offsets.
Okay, that's good to clarify. So to understand why this is happening at all, we need to be clear on default. What does that actually mean for federal student loans, according to these sources?
Right. It's not just missing a payment or two that's usually called delinquency. Default, based on the info we have, typically means you haven't made payments for quite a while. Often it's cited as 270 days for direct loans. It's a much more serious status.
So if someone's worried, what are the signs? What are the red flags mentioned in the material that say, hey, you might be in default and at risk?
Well, the big ones are getting an official demand letter. This would come from the Department of Education or maybe a collection agency working for them. Also, check your credit report. You'd likely see the loan marked with a defaulted status. That's a pretty clear sign. And, of course, if you start getting calls or letters from a debt collector specifically about your federal student loan, that's another major indicator.
And the consequences go beyond just the benefit cuts, right?
Oh, absolutely. The sources are clear. Default can lead to wage garnishment, losing eligibility for any future federal student aid, and, yeah, serious long-term damage to your credit score. It really can impact your financial life quite broadly.
Okay, this definitely sounds serious. So if someone gets one of these notices, a letter about an offset or that demand letter, what's the absolute number one thing they need to do based on this guidance?
The message from the sources couldn't be clearer. Do not ignore it. Ignoring official notices about defaulted federal loans or potential offsets, that's pretty much the worst thing you can do. It just makes everything harder down the line.
Right, ignoring it won't make it go away. So, okay, they've got the notice, they're not ignoring it. What's the immediate action plan laid out in the sources?
First step, verification. Log into studentaid.gov.
Yep.
You need to confirm, yes, these are federal loans, confirm they are actually listed as defaulted, and figure out exactly who holds the loan, now is it the Department of Ed directly or a specific collection agency.
Okay, get the facts straight first and
Of that,
then.
contact that loan holder or debt collector immediately. That's your first point of contact. And be ready to talk about your financial situation. Be open. The goal really is to ask, what are my options to get this loan out of default and stop this offset?
Makes sense. So what are those options? What pathways out of default do the sources mention?
There are primarily two main routes described. The first is loan rehabilitation. This one often gets highlighted because if you complete it successfully, the default status actually gets removed from your credit report. It's like a cleaner slate. It usually involves making 9 affordable voluntary payments over 10 consecutive months. Finish that, and the offset stops.
Okay, rehabilitation sounds like a good path if possible. What's the other main one?
The other big one is loan consolidation. This means you combine your defaulted federal loans into a totally new direct consolidation loan. The advantage: it gets the loans out of default status immediately and stops collections like offsets right away. But the catch is you usually have to agree to repay this new consolidated loan under an income-driven repayment plan, an IDR plan.
So faster resolution, but maybe tied to a specific repayment plan.
Exactly. And of course, the sources also mention the obvious. Paying the loan in full stops everything. And maybe, just maybe, in some less common situations for federal loans, negotiating a settlement for less than the full amount could be on the table.
What if someone thinks there's a mistake? Like, this isn't my debt, or the amount is wrong. Can they fight the offset itself?
Yes, definitely. The sources say you have the right to dispute. If you believe the debt isn't yours or the amount is off, or maybe you have a valid defense like the school closed or there was false certification involved, you can dispute the offset. You need to follow the specific instructions on the notice you received. The material also mentions, though maybe in limited cases, you can request a hearing to challenge an administrative wage garnishment, which includes these Social Security offsets.
Okay. Now, are there any specific lifelines or considerations mentioned just for older borrowers or those with disabilities? They seem particularly vulnerable.
Yes, there's a very important one highlighted: the total and permanent disability TPD discharge. The criteria, as laid out in the sources, involve being unable to engage in any substantial gainful activity, basically. Significant work for pay because of a physical or mental impairment. And that impairment has to be expected to last for at least 60 months, so 5 years, or be expected to result in death.
And if you meet those criteria, what happens?
A successful TPD discharge can completely wipe out your federal student loan debt. Gone. The sources explain you can apply through disabilitybenefits.gov or sometimes by providing proof from the Social Security Administration, like an award letter showing a long review period or documentation from your doctor.
That sounds like a critical option for those who qualify.
Absolutely. And it's worth repeating, even if a full discharge isn't possible, those income-driven repayment plans we mentioned, after you rehabilitate or consolidate, an IDR plan can lead to really low payments, sometimes even $0 per month if your income is low enough compared to your family size. That's also in the material.
So there are ways to manage even if discharge isn't an option. Thinking preventatively now or just managing loans better going forward, what proactive steps do the sources recommend? How can people avoid getting into this mess?
Several key things come up. Number one, keep your information current. If your loans aren't in default, tell your loan servicer about any changes: income, family size, disability status, and especially your contact info. If you're receiving benefits, keep the SSA updated too. If they can't reach you, they can't help you before things escalate.
Seems basic, but probably crucial. What else?
Keep records. Meticulous records, copies of everything: letters, payment confirmations, notices. This stuff is gold if there's ever a dispute. Also, regularly check your loan statements and your Social Security benefit statements. Look for anything unusual. Catch problems early. And finally, the sources really emphasize seeking help from reputable places if you're struggling. Nonprofit credit counselors or student loan advisors, not just random companies promising quick fixes.
Good advice. Let's zoom out for a second. What about the bigger picture, the policy context here? The sources touch on that too, right?
They do. And the numbers are pretty stark. The material mentions that the number of people having their Social Security garnished for student loans jumped massively from about 6,200 back in 2001 to nearly 192,300 by 2019. And the estimate now is that around 4 million borrowers are behind on payments and could be at risk of default later this year. That's a huge number.
Wow. And there's a debate about whether this should even be happening, according to the material.
Yes, it presents both sides. On one hand, advocates argue that taking Social Security benefits, which are meant for basic living expenses in retirement or disability, Kind of undermines the whole point of student loans, which were supposed to improve financial stability, right?
Right. It seems contradictory.
It does feel that way to some. The counterargument presented is, well, more straightforward. A debt is a debt. Student loans are owed to the government, and the government needs tools to collect what it's owed, just like any other debt. And that policy decision we discussed earlier, reinstating collections in 2019 and setting the $750 minimum that's presented as a clear example of prioritizing debt recovery, perhaps over a higher level of benefit protection.
So wrapping this up, what's the main takeaway from this deep dive into Social Security cuts and defaulted student loans? It seems like a really tough situation.
It is a serious challenge, no doubt, especially for vulnerable groups. But the overwhelming message from these sources is that it's not hopeless. You're not helpless.
Okay.
Yeah, the key really seems to be understanding your rights, knowing the warning signs, acting fast if you get a notice, and really digging into those options. Rehabilitation, consolidation, maybe TPD discharge. The sources make it clear there are concrete steps you can take to protect those essential Social Security benefits and work your way out of default. Knowledge and quick action are your best tools here.
And that brings us to a final thought, maybe something for you, the listener, to consider based on all this. Think about that policy shift, lowering the protected benefit amount from potentially over $1,800 down to just $750. What does that specific choice really signal about how we balance recovering government debt against protecting the basic financial stability provided by social safety nets like Social Security? It's a really fundamental question about priorities, raised directly by the information we've discussed. If you found this deep dive into Social Security benefit cuts, your guide to defaulted student loans helpful, you can find more information, resources, and strategies like the ones we discussed by subscribing to the Financial Freedom Insights newsletter mentioned in our sources. And please share this deep dive with your network. Let's help grow this community of informed people navigating these important financial issues.